Valuable advice: attitude determines everything. Don't view the stocks you own as mere certificates with fluctuating prices. Avoid panic selling due to economic or political events that make you anxious. Instead, imagine yourself as a partial owner of the company, just like owning a farm or an apartment with family members. Many stock market participants hope for immediate returns, wishing their money would multiply overnight. They constantly monitor stock charts, wondering, is it rising again? While this emotional roller coaster is understandable, it's not a successful investment strategy. Buffett bluntly states, expecting a stock to rise the next morning is foolish. I once heard a friend's speculative journey in the stock market. Initially, he rushed home from the trading floor, opened his computer, and fixate on stock prices. When there was an upward trend, he'd celebrate. When it did, he'd furrow his brow and fret. This behavior resembled gambling more than investing. Fortunately, luck favored him, and he made substantial gains in several trades. Later, he refined his speculative approach, focusing on buying low and selling high. Here are his key insights. E. Follow the trend. For individual investors, following the crowd is the quickest way to profit. Recognize that, given your resources, creating market highs isn't feasible. Agility matters when tracking institutional moves. R. Art of following. Following isn't blind obedience, it's an art. Be swift. Don't wait until everyone else has profited, act promptly. Fun. Game of chess. The stock market involves multiple players. In an upward trend, bear traps abound. To profit, you must ride the roller coaster and outweight institutional players. Stay one step ahead in your thinking. 4. Avoid greed. Many short-term traders exit at the first sign of profit. This common pitfall stems from lack of confidence in their judgment. They fear missing out. 5. Risk management. Stocks don't rise indefinitely, everyone stumbles. Accept risk as part of profit-seeking. When trapped, cut losses at your predetermined stop-loss point. Don't hesitate to sell. Some investors cling to hope, wanting to average down. But remember, if you're confident in a dark horse, averaging down can be effective. My friend's speculative theory worked well. His Bible earned him substantial gains. However, good times don't last forever. Suddenly, the bullish market reversed, catching him off guard. His investments vanished, and he suffered significant losses. This outcome was almost inevitable in speculation. After that, my friend disappeared from the scene, buried in debt. In contrast, Buffett's success lies in viewing himself as a business owner, not fixating solely on stock prices like many speculators. To become a Buffett-like legend, adopt an entrepreneurial perspective. His investment, not speculation mantra is famous. He doesn't care about tomorrow's quick gains. He assesses long-term value and future earnings. Remember, long-term thinking is golden. Let's delve into the difference between investment and speculation. E. Investment. 星号 definition. Investment involves allocating capital with the expectation of securing returns over the principal amount in the future. 星号 basis. Decisions are based on fundamental analysis, which assesses the performance and intrinsic value of the company or asset. 星号 approach. Investors aim for long-term growth and stability. They buy and hold assets, considering factors like dividends, interest payments, and overall value appreciation. 星号 risk. Typically, investments carry average or below-average risk. 星号 example. Imagine investing in a stable multinational company with consistent dividends and low business risk. The goal is steady returns over time. R. Speculation. 星号 definition. Speculation involves risky financial transactions to make large-scale gains from price fluctuations. 星号 basis. Decisions are often based on hearsay, technical charts, and market psychology. 星号 approach. Speculators actively trade assets, seeking short-term profits. Their success depends on chance or external forces. 星号 risk. High-risk speculation is akin to gambling. Xinghao example, buying and selling a stock rapidly based on price movements, without considering long-term fundamentals, falls under speculation. Fan. The story of two monks. Xinghao scenario, two monks, A and B, were tasked with carrying water up a steep mountain. Xinghao A, investment, diligently followed their master's instructions, enduring hardship. He viewed it as building a foundation for long-term success. Xinghao B, speculation, B sought shortcuts, diverting water from a nearby spring. He avoided suffering but faced consequences when a flood hit. Xinghao lesson, A's investment paid off, while B's speculation led to disaster. 4. Buffett's perspective. Xinghao investment attitude. Warren Buffett, an investment guru, emphasizes understanding the difference between investment and speculation. He advocates for thorough research and risk management. Xinghao investment versus speculation. Buffett believes that speculation is reasonable in certain market opportunities, but long-term success lies in true investment. Remember, understanding the distinction between investment and speculation is crucial for navigating the stock market effectively. If you want lasting success, follow the path of the diligent monk, like A, and focus on true investment. Finding the right spot, a tale of speculation and investment. In the bustling stock market, everyone hopes to make a profit. The frenzy of chasing highs and lows disrupts the tranquility of the market. However, what we truly need is a stable investment environment. While we shouldn't criticize those who profit from speculation, we must also resist the urge to become speculators ourselves. As aspiring investors, our duty lies in maintaining a stable market, a path to success for those with strategic foresight. Speculators in the stock market resemble headless flies, buzzing around in search of any opportunity. But with countless investors, both retail and institutional, how can we small players compete with the big fish? By the time we get to the cracked egg, it's likely the shell has already disappeared. Why exhaust ourselves in futile pursuits? Sometimes, we end up battered and bruised. Warren Buffett's advice is simple. Find one or two promising stocks and patiently wait. Now, let's delve into a story. Once upon a time, Monk A, fleeing danger, arrived at a remote mountain village. Determined to settle down and escape a life of hardship, he decided to stay. The village was secluded, surrounded by mountains, and its inhabitants survived by gathering wild fruits and catching fish from the nearby stream. Water was fetched from various mountain springs. However, the fruit supply was scarce, fish were dwindling, and water availability fluctuated, sometimes abundant, other times scarce. Monk realized this situation was unsustainable. Inspired by his clever fellow monk, Monk B, who had met an unfortunate end, he decided to improve the villagers' lives. Monk planted fruit trees, created fish ponds, and dug a well nearby. Within a few years, the mountain was fragrant with fruit, fish thrived in the ponds, and the well provided fresh water daily. The villagers enjoyed a newfound prosperity. Similarly, in the stock market, many investors toil tirelessly like the villagers fetching water. Yet, why do most end up empty-handed? Their relentless pursuit of speculation buying here, selling there often leads to disappointment. Instead, we can learn from Monk A. Rather than chasing every opportunity, we should find the right spot, invest wisely, hold quality stocks, and avoid the speculative frenzy. Many successful investors spend minimal time in the market, focusing on a select few stocks and riding the waves. Just as digging a well requires understanding the terrain and water sources, successful stock investing involves reading market trends and identifying industry leaders. However, the market, influenced by speculation and bubbles, remains volatile. Speculators may temporarily control it, turning it into their personal ATM. But this distortion undermines investment's purpose, eroding returns and hindering resource allocation. Speculators chase short-term gains, ignoring intrinsic value. They buy low and sell high, regardless of a stock's true worth. Conversely, investors seek undervalued stocks for long-term holding, sharing in a company's profits. Buffett's approach disregards speculation. Our goal is to invest in quality stocks and earn profits. We don't need to dissect complex theories. By analyzing the market with an investor's perspective, we can cut through chaos and find our path to success. George Soros, a prominent speculator, once said, "Economic history is a continuous drama based on illusions and lies. It doesn't follow a true script, but it paves the way for accumulating immense wealth." Recognize the illusions, participate, and exit before the public catches on. Buffett, on the other hand, rejects speculation. He believes in understanding intrinsic value and cutting through illusions. By focusing on long-term value, we can find our way through the market's chaos. Lastly, let's remember, investing should be joyful. Unlike speculators, who tremble with fear, investors enjoy the art of finding hidden gems. Over time, the market becomes simpler, and we share its rhythm. The pleasure lies in the journey, a secret only investors can truly appreciate. Reflecting on Monk A and Monk B's reunion in their dreams, Monk A remained content, while Monk B couldn't change his fate. Monk A's tranquil life, shared with the villagers, was a testament to his wise choices. As for the stock market warriors, why not embrace the joy of investing alongside the pursuit of profit? Over time, the market becomes familiar, and investors breathe the same air, sharing their destiny. This unique pleasure belongs exclusively to those who walk the path of joyful investment. In the fifth section of our analysis, we delve into Warren Buffett's strategic move into the energy sector. Despite being 74 years old, the legendary investor still possesses the Midas touch, turning opportunities into gold. After a period of relative quiet, Buffett made headlines once again by targeting the booming energy industry. His latest venture involved acquiring Pacific Corp, the largest power supplier in the U.S. Northwest, through his company, Berkshire Hathaway. The deal, valued at a staggering $9.4 billion, marked Buffett's largest transaction since his acquisition of General Reinsurance Corporation in 1998. With Pacific Corp under its umbrella, Berkshire Hathaway's subsidiary, Mid-American Energy Holdings Company, expanded its customer base to include Oregon and Utah, creating an energy giant with annual sales exceeding $10 billion. Buffett's interest in the energy sector is strategic. In his statement, he emphasized the long-term investment potential. "We have always been intrigued by the energy industry, and this is a suitable long-term investment." As a leading power company in the U.S. West, Pacific Corp boasts significant asset advantages. Why did Buffett choose Pacific Corp? He recognized the company's predictable cash flow in the energy industry. "We've always had a keen interest in the energy sector, and now is a fortuitous opportunity," he said. Calculating the acquisition price, the price-to-earnings ratio for purchasing Pacific Corp stands at 20.3. Considering the $9.4 billion price corresponds to $12.52 billion in total assets, the acquisition represents a discount of 33.2%. From a valuation perspective, the price may not be low, but Buffett's focus lies in the company's growth prospects and stable cash flow. Pacific Corp derives 40.6% of its electricity sales revenue from Utah, a state experiencing rapid economic development with a 4% annual increase in power demand. Additionally, the company's operating cash flow over the past 3 years has been $6.8 billion, $8.3 billion, and $7.1 billion, respectively. These figures underscore Buffett's emphasis on intrinsic value and future potential. Critics may label Buffett's move as speculative, given the surging international oil prices and global energy scarcity. However, a closer analysis reveals that Buffett's entry into the energy sector isn't about chasing short-term gains. Instead, he aims to capitalize on the energy market's recovery, establishing a long-term revenue stream. This aligns perfectly with his investment philosophy, which distinguishes between speculation and true investment. Buffett famously said, "When I buy a stock, I think of myself as a business analyst, not a market analyst, security analyst, or macroeconomist." His success in the stock market stems from thorough fundamental analysis, not market timing or insider information. By focusing on long-term value, Buffett has made the U.S. capital market one of the most stable, mature, and vibrant financial markets globally, a fundamental pillar supporting the country's long-term economic prosperity. In conclusion, a robust economy requires a stable capital market. Buffett's latest venture into the energy industry exemplifies his commitment to long-term value creation. As we navigate the financial tides, remember Buffett's wisdom: only when the tide goes out do you discover who's been swimming naked. After the storm, the market crowns Buffett as the reigning king, and Fortune magazine has rightfully named him one of the most influential people in America. Let's embrace his investment philosophy, recognizing that investment, not speculation, leads to market success. Long-term investment, as Buffett aptly puts it, allows us to enjoy the compounding growth. So, after reading this book, may you truly grasp the wisdom of Buffett's investment approach and become a smart investor like him. Always remember, speculators falter, investors thrive. This principle defines the stock market, and when you shift your mindset from speculation to investment, you'll view the market with discerning eyes, securing your winning position rather than relying on luck or superstition.